Have you ever looked at the world's richest people, the absolute top, the 0.001%, and wondered how they actually built that wealth?
Mm-hmm.
Because, well, if you really dig into it, the path for them, the real lasting fortune, it isn't a massive salary.
Nope.
And it's not primarily just market investing, and definitely not passive income from, like, standard real estate.
That's exactly the core idea we're unpacking today. The real road to, let's call it go-away money. It's owning an asset, a business, one that's inherently valuable enough for someone significant to want to buy it.
Okay.
So today, we're focusing on the 7-step framework. It's all about maximizing what the finance folks call enterprise value.
Right.
Which really is just how much somebody is willing to pay you for your whole operation. So the focus shifts,
Yeah.
away from just making money month to month.
In making the business itself worth a fortune. Okay, let's get into this. Our mission here is to move you, the listener, from that sort of daily grind, the cash flow focus, to the more strategic work of creating a real asset. These 7 steps, they're distilled from our source material, and they should give you a pretty clear roadmap.
Yeah, hopefully.
Follow them, and you create something that, well, it grows on its own, it reduces risk, and crucially, it attracts the highest possible sale price down the line. So let's jump right in. Foundational layer first, predictability and profit.
Okay. So step 1. This is non-negotiable, really, for building value. You have got to make your revenue predictable. Buyers call this durable revenue.
Predictable. Certainty. That's what buyers pay top dollar for, isn't it? They don't want to gamble. They want assurance.
Exactly.
When they look at your financials, say the trailing 12 months, maybe 24 months, they need to see stability. Or even better, an upward trend, something that lets them confidently predict future cash flow.
Think about telecom companies. Why are they worth so much?
The phone bill. Every month, like clockwork.
Right. That predictable, reliable, durable income stream, that's gold.
But isn't that mostly for, like, subscription businesses, software as a service, things like that?
That's what's so interesting. It's not just for SaaS. Every business, well, almost any business, can engineer some form of recurring revenue.
Really? Like how?
Okay, we've seen examples like home builders. They build the house, then they offer ongoing lawn care, snow removal contracts.
Okay. An add-on service.
Exactly. Or like a sign company. They install a big sign for a business, then they sell a mandatory annual maintenance contract with it.
Gotcha.
It takes some creativity, sure, but building that predictable stream, it instantly de-risks the business, makes it fundamentally more valuable.
Okay, so durable revenue, get your foot in the door. But to really juice that valuation, we need step 2, increasing your gross margin. You hear that saying, right? Revenue is vanity, profit is sanity. But when you're talking valuation, selling the company, a buyer's focus, it's almost entirely on EBITDA.
That's absolutely right. And maybe we should slow down on that acronym for a sec. EBITDA.
Yeah, good idea.
It stands for earnings before interest, tax, depreciation, and amortization.
Right.
And buyers use it because it shows the, let's say, true operational health of the business before you factor in the owner's specific financial choices.
Like how much debt they took on or where they're based for tax purposes?
Exactly.
Yeah.
So buyers pay a multiple of that clean operational number. Maximize your margin, you directly boost your sale price. Simple as that.
Okay, gross margin. Simplest way to think about it. The money you keep after you cover the direct cost of what you delivered.
Pretty much.
Like the lemonade stand. You charge $2. The cup, lemons, ice cost 25 cents. Your gross margin is $1.75.
Perfect analogy. And the best companies, they are relentless about maximizing that $1.75.
So how do we do that? What are the levers we can pull to increase margin?
Okay, there are 3 main levers. First 2 are pretty obvious. 1, decrease costs.
Standard stuff. Use AI, automation for back office things, negotiate better prices with suppliers.
Yep. Volume discounts, finding efficiencies, that's lever 1. Lever 2, increase prices.
This is literally the first thing a private equity buyer does when they take over.
Almost always. But your ability to actually raise prices successfully depends on having built enough demand, enough brand equity, quality perception, so you don't just lose all your customers.
Right, it relies on the groundwork. Okay, but the third lever, this is where it gets uncomfortable, isn't it? The thing founders hate doing.
Dropping unprofitable clients. Yes. It's often the highest leverage move that most people just refuse to make. Seriously, if a professional buyer walked in tomorrow, they would immediately identify and, well, Fire the bottom 10% of your clients?
Who are those bottom 10% usually?
Often the ones who complain the most, right? Or maybe they got some super deep discount years ago, a legacy deal, or they just take up way too much time and resources because they're not really your ideal customer type. They're drain capacity, they hurt morale.
Okay, but why does firing them increase the value of the business? Seems counterintuitive.
It increases value because, 1, it cleans up the books. Margins look stronger instantly. 2, it reduces operational complexity. And 3, it frees up your team's time and energy to serve your best, most profitable clients even better.
Ah, so the business looks more scalable, less stressful to run for a potential buyer.
Exactly. And look, the easiest way to fire these anchor clients often is just raising prices strategically until they decide to leave on their own. They self-select out.
That makes a lot of sense, actually. Value creation means focusing on scalability, maybe not just obligation. Okay, moving on. Section 2. This feels like it's about stacking those profits over time. Retention.
Precisely. If we've boosted profit with step 2, the next logical thing is to protect it. So, step 3, reduce client churn.
The leaking bucket, I've heard this analogy.
It's critical. You're pouring resources, new sales into the top. But if customers are constantly licking out the bottom, churning that bucket, your business value, it just never fills up.
Right.
And the shocking thing is, many businesses are losing like 100% of their customer base every 10 months or so and don't even know it because they aren't tracking churn properly.
Wow.
Yeah, high churn, say 10%, 15% a month. That's like a cancer for company worth. It just eats away at it.
You see this sometimes with local places, right? A little shop, maybe grocery store. They just gradually burn through everyone nearby. People stop coming back. Bad experience. Maybe they're always out of stock. Staff leaves. Revenue dips. And if they try to sell, the business itself is basically worthless. It's just selling the building.
It's the danger. So the fix, it starts with tracking. You absolutely must track your MRR, monthly recurring revenue from existing customers. Know who stayed, who left.
Okay, measure it first. What else?
Second, you need to aggressively reduce the time to first value, TTFE.
Time to first value, meaning...
Give customers a quick win, fast. Ideally, like within their first interaction or definitely within the first week.
That sounds good theoretically. But for, say, a service business, delivering value that fast, doesn't that mean more upfront work for the owner?
It absolutely does. It's short-term effort for massive long-term gain. Think about it. Client joined your gym. Don't wait. Give them their first week's workout plan right away.
Okay.
They sign up for your consulting. Instantly deliver some kind of checklist or cheat sheet they can use tomorrow. Speed to results. That builds stickiness. That cuts churn.
Makes sense. Get them invested quickly.
And one more thing here. Implement a cancellation capture flow. When customers leave, they are taking incredibly valuable feedback with them.
Why they left.
Exactly. If you don't capture that exit data, if you don't systematically learn why people are leaving, you can't fix the underlying problems for the customers who are still with you. Your speed of growth is directly tied to how fast you learn from these mistakes.
Okay, stop the leak with tracking, quick value, and exit interviews. So if we stop the churn, the next step must be making sure the customers we keep are worth more over time.
You got it. Step 4, increase customer lifetime value, or LTV.
LTV. That's the total average amount a customer spends with you during the whole relationship, right?
Correct. And buyers look at LTV right alongside the cost of acquiring a customer.
High LTV, low CAC. That's the dream combo.
That's the valuable engine. Look at Netflix, their huge valuation. It's directly tied to their power to increase LTV, raising prices, cracking down on password sharing. It's all about maximizing the value of each subscriber relationship.
So strategically, how do we push LTV higher? It can't just be raising prices across the board all the time.
No, it needs to be more sophisticated. 3 core strategies usually. First, add upgrade paths. Think about usage-based pricing.
Like pay per user or per feature.
Exactly. Are you maybe being a bit too generous in your current base offering? If so, you're leaving money on the table. Software uses per-seat pricing. Netflix charges for extra screens. You want to capture more value from your heavier users.
Okay, upgrade paths. What's number 2?
Monetize additional related services. Ask yourself this question. What does my customer typically do? Like 3 minutes before they use my service and 3 minutes after.
Okay, the gym example again. Before, maybe they buy workout clothes, supplements.
Right after. Maybe a protein smoothie, healthy snacks.
So you could offer those things at the gym. Capture that spend.
Precisely. These are adjacent opportunities. Find them and monetize them.
Okay. And the third strategy, using data.
Yeah, using the data you should now be collecting to create expansion triggers.
Meaning,
Use customer behavior to prompt an upsell or cross-sell. Dropbox is famous for this, right? You hit 80% of your storage limit.
you get that email suggesting an upgrade.
Yeah. Or if a gym member starts coming, say, 7 days a week really frequently, that's a trigger. That's your cue to suggest personal coaching, maybe nutrition services.
Got it. Use their actions to offer more value and charge for it.
And when you manage to significantly increase LTV without constantly needing new customers, you effectively turn your business into this kind of self-growing annuity. It just compounds.
Safer, grows on its own.
Yeah,
Very attractive to a buyer.
hugely attractive. Okay, moving into our third section. The focus here really shifts to stability. Buyers hate risk. So now we talk about de-risking the asset you're building. Step 5. Don't put all your eggs in one basket. Tackling concentration risk.
Concentration risk, like relying too much on one big customer.
That's a major one. Say one client makes up 60% of your revenue. Or maybe you get all your leads from one key partner. Or you depend on a single supplier for something critical. That's the danger zone.
Yeah, I heard a story once, like a warning from a father to his son who was running a business.
Oh, yeah.
Said if one customer grows too big, like from 40% of your revenue to 70%, suddenly they realize they have all the power.
Yeah.
They could, in theory, just stop paying their invoices. You've already spent the money to serve them. You can't make payroll. And then they could potentially swoop in and buy your company for peanuts from the bank when you default.
That's a chilling and entirely plausible scenario. It highlights the risk perfectly.
So what are the targets? How do we know if we're diversified enough? Give us some numbers.
Okay, concrete guardrails. You want to keep your single biggest client under, say, 15% of your total revenue.
15. Okay.
And ideally, your top 3 clients combined shouldn't be more than about 30%.
Right. So if any one of them leaves unexpectedly,
You're still profitable. You have breathing room to replace them. It doesn't sink the ship.
and this applies to marketing channels too, right?
Yeah.
Not just customers.
Absolutely. We saw a case where a business got like 85% of its leads from Instagram ads, 85%.
Wow, that's risky. One algorithm change.
Exactly. Or their ad account gets shut down for some reason. Business evaporates overnight. They had to scramble, diversify fast, get that reliance under 40% within about 6 months. Diversification equals stability. Stability equals value.
Okay, risk reduced through diversification.
Yeah.
Now, systemization. Step 6. Write down how everything actually works. The playbook.
Yes. SOPs, standard operating procedures, checklists, whatever you call them. Undocumented processes. They're a trap.
How so?
They tie the founder, the owner, directly to the day-to-day operations. It signals to a buyer, hey, this place only runs because this specific person is here. The buyer needs to know the secret sauce is baked into the system, not just stuck in one person's head.
The classic example is McDonald's, right? The Big Mac.
Perfect example. Their SOPs are so incredibly detailed, so tight, that literally a teenager in Tokyo can make a Big Mac, and it tastes exactly the same as one made by a teenager in New York.
Right. Fries too, everything.
Everything is documented. That system, that replicability, that's a huge part of why their enterprise is worth billions, not just the real estate or the daily cash flow.
So how do you actually build this playbook? Sounds daunting, like months of writing.
It used to be, but doesn't have to be now. We recommend something called the camcorder method.
Oh,
Just record yourself doing a recurring task. Maybe it's processing accounts receivable. Maybe it's how you schedule a certain type of sales call. Turn on your phone camera, screen recording, whatever, and just talk out loud. Explain exactly what you're doing, step by step, and why you're doing it that way.
And then what? You have a bunch of videos.
Then you can use AI transcription tools or even just have an assistant watch it to generate the written SOP from your recording. Store it in a shared place like Google Docs or Notion. Build a company wiki.
Okay, that sounds more manageable. But still, taking the time to record yourself doing tasks, doesn't that slow the founder down, especially when they're already swamped?
It absolutely creates friction in the short term, no doubt.
Yeah.
But you have to see it as an investment. That short-term pain buys you long-term freedom.
Oh.
Because if you create a system so clear that someone else can execute a task perfectly without you having to explain it every time, you've created a truly valuable, repeatable process.
It's not just about reducing founder dependence for a sale. It's about ensuring that predictable revenue we talked about way back in step 1 actually continues, no matter who's doing the job.
Exactly. A well-documented business isn't just easier to sell, it's easier to scale, easier to manage, easier to grow before you even think about selling.
Okay, that leads us perfectly into the final step, The ultimate lever, really. The one that unlocks the highest valuations and potentially frees the entrepreneur the most. Step 7, build a leadership team.
This is the capstone. If you nail this, your job as the owner shrinks dramatically. It basically becomes just 3 things: vision, money, and people. Your leadership team, they run the company day to day. They make the bulk of the operational decisions.
And buyers care a lot about this team.
Oh, hugely. They will spend significant time interviewing your key leaders during due diligence. If they sense the team is weak, or if they think they'll have to replace people right after buying, they will literally deduct the expected cost of hiring replacements straight from your sale price.
Ouch. Okay, so there's a difference between just hiring people and building a leadership team.
Big difference. It's easy to hire people and just tell them exactly what to do every day. That's management. It's much harder, but infinitely more valuable, to find and empower people who start telling you what should be done.
Because they have true ownership, accountability.
Precisely. You have to give them the keys, metaphorically speaking. The responsibility, yes, but also the authority to make decisions.
Is there an ideal order to hire these leaders?
Generally, yes. Start with operations first. Get your finance lead, maybe HR, recruiting, tech system stable. Build a reliable machine first.
Okay, get the engine running smoothly.
Then, once that's stable, you transition to hiring your marketing and sales leaders, because now you have a solid foundation to support the growth they'll drive.
And how do you ensure they actually lead, not just wait for direction?
A key piece is a self-reporting dashboard. True leadership means the team members themselves track and report their key results. They update the dashboard, they report to their peers, they hold themselves accountable to the targets.
So the owner isn't chasing them for numbers.
No. The owner becomes more like a coach, a strategic guide, correcting course when needed, asking tough questions, but not driving the bus day to day.
And what about decision-making? To avoid becoming the bottleneck for every little expense or problem.
You need clear decision frameworks. You have to consciously push authority down to the people closest to the information, the ones who can actually solve the problem fastest.
Like setting spending limits.
Exactly. We often see simple dollar rules work well. Maybe anyone on the team can spend up to $50 to fix a customer issue on the spot, no questions asked. Managers might have authority up to $500. C-level execs may be up to $50,000 for certain things without needing prior approval.
Whoa, $50,000 without approval. That sounds risky. What if they make a bad call?
Well, there have to be guardrails. The rule is usually you can make the decision if it's within your budget and authority, but you must notify your superior immediately after you've made it, explaining the rationale.
Oh, okay. So there's still accountability and transparency, but it allows for speed.
Precisely. Speed and empowerment. Combine that with a mandatory, well-structured weekly leadership meeting.
What makes it well-structured?
The key rule: leaders don't just bring problems to the meeting. They must bring the problem and their proposed solution or idea for how to tackle it.
Ah, solution-oriented.
Exactly. This whole system, empowered leaders, clear authority, accountability, solution focus, it dramatically reduces buyer risk. It shows the company is mature, institutionalized. It's not just dependent on one person.
That breakdown really clarifies it, shifting from just managing to actual governance.
Okay.
Let's bring this all back home for you, the listener. The core message here is pretty clear. Real, significant wealth creation is generally not about chasing that monthly active income figure forever. It's about strategically, intentionally building enterprise value. These 7 steps we walk through, from nailing down durable revenue and boosting margins, all the way to de-risking the operation and building strong leaders, they create an asset, something that grows, something stable, something highly desirable to a potential buyer.
Yeah, think of this framework as, I don't know, a master plan. A way to turn what might feel like just a job into a strategic, valuable asset. And look, we covered a lot. It can feel like, wow, that's 7 big things.
It can be overwhelming, yeah.
So we'd really encourage you. Just look at these 7 steps again. Pick one. Just one area you feel you can realistically commit to improving over, say, the next 90 days.
Just focus on one piece first.
Exactly. If you consistently tackle just one of these areas each quarter, you will fundamentally transform the underlying worth of your company. Likely within just a year or 2, it compounds.
Okay, a final thought then. We talked a lot about how critical reducing churn is and also increasing lifetime value, LTV. Both are about the long-term health, the safety, the growth potential of your customer base.
Yeah. Key predictors.
So if you were forced right now, today, to measure only one single metric to give you the best possible prediction of your company's future valuation ceiling based on everything we discussed, Which would you choose? Would you prioritize nailing down your current churn rate or figuring out your true customer lifetime value, LTV?
Good question.
That's something to chew on until our next deep dive.